Okay, let's get started. Good afternoon. This is Brian McGann. I'm the head of investment strategy here at Beacon Trust, and welcome to our initial 2020 client webinar. With me today is Dr. John Longo, our Chief Investment Officer, who I know that most of you on the line are familiar with. John's going to go through a little bit of the 2019 market review and our outlook for 2020. It includes a piece that John wrote that we broadcast out a couple weeks ago that includes 10 predictions, if you call them predictions, for 2020. We'll review our 10 that we did for 2019, but more importantly, our outlook for the financial markets, the economy in the year 2020. First, I'll wish everyone on the line a happy new year. I hope you had a great holiday season, and we're ready to kick off the year of 2020, which should be quite interesting. I don't want to take up too much time, so just 2 points on logistics. Everybody's on listen-only mode. If you have any questions during the webinar about any of the material, there's a question box in the lower right-hand side of the webinar. Please feel free to type them in there or email them to support@beacontrust.com. Today's slides are going to be available on our website. And we'll post those later on today. We're recording the call, and we'll also post that onto our website in the Insights section. So that's all I really wanted to say as an introduction. So I'm going to pass the call over to John.
Thank you, Brian, and good afternoon, everyone, and welcome to our recap of 2019 and outlook for 2020. Now, 2019 was a great year. I'll give you the specific numbers in a moment, but one thing we try to educate our clients on is not to be focused so much on a year-over-year calendar basis. So in a minute, I'll show you the exact numbers, but the S&P was up 31.5% in 2019. A fantastic year, the best since 2013. But if you go back on a two-year basis, you can see if you're looking at the screen, on a price return basis, it's up around 20%. Let's call it 20% with dividends, and we take that divide by 2, that's 10% per year. So on a roughly two-year basis, it's in line with the long-term averages. On a one-year basis, it's way ahead. But clearly, we were happy with 2019. You know, in hindsight, it's easier to say maybe what caused the run-up. I think the most important thing was the Fed moving from a hawkish position to a dovish one. It might be a while to remember, but coming into last year, the Fed was expected to raise rates 3 times. In fact, they lowered them. The second thing, which I think was the main cause of the volatility that we had intra-year, were the trade tensions between the U.S. and China. And as you know, a phase 1 deal was reached, officially being signed this week. And then there were some other reasons that maybe had lesser impact. We had the longest government shutdown on record that ended early in the first quarter of 2019, and there was also some investor enthusiasm resulting in an increase in the market multiple. So just to give you some specifics, I mentioned the 31.5% number for the S&P, but that was really led by technology. Technology obviously is a sector within the S&P. We all know about Apple and Facebook and Google. So technology had an incredible 50% increase, which is really amazing because they've had great performance before that and several years prior to that. So technology tends to fall within the growth universe, and you can see growth outpaced value by about 10%. And they also outpaced small stocks as well as international. So pretty much every equity category did well, but to have the best performance, you probably needed a healthy dose of technology and large cap growth. We were also delighted with the performance of fixed income last year. Typically, you expect fixed income to return low single digits, at best mid-single digits, but the most popular bond index, the Barclays Aggregate, was up 8.7%. And even munis, which as you know are essentially tax exempt, were up almost 4%. And alternatives have lagged quite a bit in recent years, in fact, and sometimes they've had negative returns, and they had respectable performance, generally higher than most fixed income categories, but below equity. So Aggregate hedge fund was up around 8.7% last year, commodities 7.7%, and REITs had a great year driven by low interest rates and some tax incentives. They were up 24.5%. If you're looking at the boxes on the right, what we see here in the first column are returns in 2019, and then the second column is the annual return over the prior, let's call it, decade and a half. And saving you the math, in almost every instance, the returns were well above average. So we'd love a repeat performance in 2020, but we don't think it's going to happen. Now, in a moment, I'm going to share with you our team forecast for 2020. And obviously, you have to take any forecast with a grain of salt, but naturally, you may be saying, well, how have your forecasts done in the past? And fortunately, they've done well. We've been doing this for many years. Obviously, I'll just go over last year's forecast, and I'll just do it quickly because the focus of this call is what's going to happen in 2020. Well, we thought stocks would deliver positive returns. We were kind of surprised how strong they were, but we moved that in the correct column. As I said a little while ago, the Fed was expected to raise rates 3 times in 2019. We thought that was aggressive. We thought it'd be 2 or less. We certainly didn't predict they'd cut 3 times, but that would still be a correct prediction, technically speaking. Now, it's good to get a prediction while the returns are higher than you forecast. We thought bonds would basically clip their coupons. That'd be, let's say, a 2 to 3% return. And as I mentioned on the prior slide, bonds were up 4 to 9%. We thought real estate prices would increase. That did, in fact, hold true. We look at the Case-Shiller index, and real estate was buttressed by low interest rates as well as a low unemployment rate. If people have a job, they're more likely to buy real estate. We thought the longest economic expansion on record will continue. And to kind of steal some of our thunder, that's one of our forecasts as well for 2020. So no recession last year. A negative forecast that came to be true. Unfortunately, our budget deficit is expanding. We thought it would exceed $900 billion. In fact, it approached $1 trillion last fiscal year. Prior to 2019, the dollar was on a really strong run. We thought that the dollar would temper its returns versus DXY, which is a trade-weighted basket. And we also thought that'd be a positive for international stocks. So both of those were correct, although, as we said, international did not keep quite the pace with equities, but most were up close to 20%. We thought coming into 2019 that maybe quality munis, for example, would outperform high yield, but that was incorrect. It was a risk-on year, and munis did well, but they lagged. In terms of what we put in the partially correct category, we thought high quality would outperform low quality. That did happen with equities. Good example might be Microsoft and Apple. Both those stocks were up 50%. They would fall in most quality buckets. But as I said a moment ago, high yield bonds did outpace quality bonds, and we didn't forecast that. Last but not least, we thought crude oil prices would increase, and they did in fact jump from 45 to 60. And near the end of my talk today, I'll talk a little bit about the risk in the Middle East. So that's closing the books on 2019. It was a great year investment-wise, and we're happy to have that in the books. And now let's move on to our thoughts for 2020. We'd love another 31.5% return for stocks. It's probably not going to happen unless we get into a bubble-type mentality. And our reasoning for that is that stocks they're not cheap. They're not crazy expensive, but they're not cheap. So if you're looking at the screen, the most common valuation metric is PE. It's been in the stock tables of the Wall Street Journal since the 1950s. And currently, the PE, forward PE, is around 18 and a half, and the 25-year average is about 16 and a half, and the average since we have data going back to the 1930s is probably 15. So on that basis, stocks are kind of expensive, but they're not crazy expensive like they were during the internet bubble. Why we're not terribly concerned, we're a little bit concerned, but not crazy concerned, is that interest rates are low and inflation is low. So when rates are low, inflation is low, the Fed's on hold, the Fed's supportive, and the market could probably support a higher multiple in the light of expected earnings growth. So we think that earnings or total returns will probably be somewhere in the mid to high single-digit range as we end this calendar year. Okay. In terms of bonds, we think bonds will be up, but also low single digits. We think it'll be kind of a coupon clipping year for bonds. The 10-year Treasury this morning is around 1.8%. So we think 2-ish is maybe what you can expect, plus or minus 50 basis points. Our second forecast is the Fed won't raise rates in 2020. As you know, the Fed, they have their meetings about 8 times a year, and over the past few years, they've been having press conferences, and they kind of give smoke signals of their thoughts. Not only that, they have Fed governors that speak around the country, and those remarks are heavily vetted. And they basically just said, we're going to sit on our hands for a while, but we stand ready to support the economic recovery if things get worse. So our view is that rates will probably be flat through much of the year, and if there's a change, the Fed might cut rates once or twice. This environment, once again, I think is a positive backdrop for stocks and bonds. That being said, I think we were spoiled last year, not only by the exceptionally high returns, but also incredibly low volatility. So if you're looking at the screen, the biggest drop top to bottom last year was only 7%. That's about half the 14% we normally have. It's one of the lowest on record. We had a drop of only 2 or 3% a few years ago, but it wouldn't surprise me to see at least one correction this year, mainly due to geopolitical volatility, both abroad and at home, with the uncertainty of the election. So I'd buckle your seatbelt a little bit. We expect volatility to kick up. When we talk about our themes near the end of the call, we think it's important to remain diversified, even though stocks have done much, much better than most asset classes, especially large cap US. Our fourth forecast is that we think earnings are going to increase. And this is another reason that helps us stay the course in terms of having a decent allocation to equities in most client portfolios. And you can see there's a whole range of forecasts on Wall Street. Everyone but Morgan Stanley is forecasting higher returns. And part of this is simple mechanics of what comprises the S&P. You follow the markets, you know, Boeing had a terrible year. There were, of course, some of the tragedies with their airliners crashing, but their earnings also took a hit. There were some other large cap firms, Exxon is one that comes to mind, and Google or others, that had one-time items that I think will be reversed this year. We have a growing economy. We have a little bit less trade uncertainty. So at the end of the year, we think earnings will be up, let's call it 5%, maybe 8 to 9% in a strong scenario. And that is one reason why we think stocks will outpace bonds, barring any macro catalyst. Moving on to forecast 5, I mentioned the phase 1 trade deal that was agreed at the end of last year and will be signed this week. But we think well, just to clarify that a little bit, phase 1 was largely focused on an increase in the purchase of agricultural products by China, and some, let's call it modest improvements in protections of intellectual property. Phase 2 would be a much more comprehensive deal. That would open Chinese markets to a greater extent. It would require them to end subsidies to areas they're heavily investing in, like robotics and AI. And we don't think it's going to happen in 2020, and maybe not ever, because it would require a very large and radical restructuring of the Chinese economy. So there might be a lot of talk about phase 2, but we don't think anything will get done formally in 2020, and maybe not for a while. I'm sure the leadership in China is also waiting to see what happens with the election. They may not want to commit to something long term when there could be a change in leadership. We don't know. We'll find out in November. Forecast 6, well, we think this longest economic expansion in history is likely to keep going. Now, one kind of point in defense of this forecast is that the current recovery has been somewhat anemic. So if you're looking at the screen, what we see here is the magnitude and length of every recovery since the recession, I guess going back to the early 1900s. And where we are today is the light blue graph at the bottom of the screen. So you can see it's the longest recovery, well over 40 quarters, but it's also been the most sluggish. So maybe we can go a couple of more years, keep growing at 2% or so, and not the 3, 4, 5% we rebounded in prior years. Now, part of this is that the bigger an economy gets, the harder it is to grow. So it's easier for the 1950s U.S. to grow at 5% than what we're facing in the 2020s. But just because the recovery has been going on for a long time, it doesn't mean it can't continue. We continually look at a range of economic indicators, and they still suggest modest continued expansion. In terms of what might do well this year, well, broadly defined, we think infrastructure is going to be a winner. Now, traditionally, when you think of infrastructure, you think about bridges, roads, and tunnels, but here at Beacon, we think 5G is part of infrastructure. We think improvements in healthcare is part of infrastructure, as well as education. And our logic is as follows. If the economy is strong and we have greater tax receipts than expected, well, we have money to spend on infrastructure. Conversely, if the economy is weak, well, politicians often like to keep us out of recession or minimize the recession, and they have to do targeted spending. So we think infrastructure might be a target for some of that spending. So certainly we'll be happy to talk offline. Each of our managers of specific strategies have certain infrastructure plays that they like, and this is, I think, a long-term theme and not just for 2020. Forecast 8, as I mentioned, I think we had very nice returns for bonds last year. We're kind of spoiled. We think at best you probably clip coupons. This is a graph of the 10-year benchmark Treasury note. And why they call it the benchmark Treasury, it's tied to two things. Number one, when companies borrow, they tend to borrow in the 5 to 10-year range. And two, if you look at the mortgage market, it's typically tied more to the 10-year than the 30-year because the average person lives in their house around 7 or 8 years. Some people might want to trade up. Some people might want to downsize and retire. Very few people live in their house 30 years or more. And just by looking at this long-term perspective, clearly we don't expect rates to surge to double digits anytime soon, but it shows you how low rates are. And there's not much room to go lower. They certainly could. My colleague Susan Hayes and I have a rough forecast of we can take the 1.8% and add or subtract 50 basis points. And that's the range we think it's going to trade at for the bulk of the year. So we don't think rates can get much lower. And then on the upside, we just saw a new inflation number today, in line with reasonable averages, 2% plus. You probably know there's $15 trillion of negative interest rates around the world. If you're a rich person in Switzerland, Germany, and so forth, 1.8% in a treasury with no risk, at least absent currency risk, is looking pretty good. So we think there's some structural forces at play that are going to keep interest rates in a band. And that basically means you're going to clip your coupon, but more importantly, they provide diversification during the inevitable market downturns. There's always drawdowns within the year. We had a 2 or 3% drawdown with some of the tensions in the Middle East. But as I said, the average drawdown intra-year is 14% top to bottom. So having that stable portion of your portfolio hopefully will prevent you from panicking and saying to sell everything when equities inevitably fall. Moving on to forecast 9 out of 10. We think real estate prices will continue to inch up, but they'll be at or below their long-term averages of roughly 3%. So kind of maybe in line with last year, perhaps slightly better if there's more enthusiasm. But as you can see on the right-hand table, an increase in real estate prices at the national level does not necessarily mean everywhere. Those living, especially in high-tax states, Connecticut, New Jersey, Maryland, have actually seen their housing prices drop from the peak well before the Great Recession in 2006. Conversely, areas with low taxes or maybe that's increasing in population, for example, the Carolinas, are seeing increases. So overall, a basket of real estate we think will do well. We do have some real estate in our open architecture portfolios, but we don't expect the rip-roaring rates that we saw after the end of the Great Recession. Our last forecast is we think inflation is going to be contained. We think the CPI year over year will be up around 2%. And that is fine. When we have deflation, that tends to result in panic for the market. And too much inflation also can result in panic. So we think we're going to head towards the Goldilocks scenario and have inflation of 2%, let's say plus or minus 25 basis points. Overall, as I said, when inflation is contained, you generally see positive returns for both the stock and bond market. So those are our 10 individual forecasts. They kind of dovetail into 4 themes that I'll share, and we'll open it up to questions. We did have some that were emailed in prior to the call. So here are some of our themes that we have for 2020 that I'm sure you'll discuss with your advisor. I'm happy to discuss these with any clients in further detail. Number one, I alluded to in our forecast that we think volatility is going to pick up fairly sharply. We had a small taste of this with some of the tension in Iraq and Iran, but I think it'll pick up even further. We don't know exactly what's going to cause it. It could be earnings volatility. It could be political uncertainty. We have another Democratic debate tonight. As we marshal throughout the year, it'll be clear who the candidate or candidates are, and depending upon what their policy positions are, it could result in turmoil. It wouldn't surprise me. A lot of investors might say, I've had a really good run since the end of the bear market. I might just cash in some coins and just ride it out. And that behavior itself could also result in volatility. Our second theme is that given the quite low level of interest rates, not zero like we saw for a while, but I'd still call 1.5% to 2% quite low, we think you got to get your income from diverse sources. Now, clearly that includes our staple fixed income, but it could include high dividend securities. It could include REITs or physical real estate. It could include infrastructure. So there's a range of investments that we have that we'll be happy to address in further detail with you, but just don't rely on your plain vanilla bonds as your only source of income. 3, we think the global economy will remain somewhat sluggish, but avoid recession. Now, we believe in having a diversified portfolio. We believe in a global portfolio, but periodically diversification doesn't work. But we think it will work this year. We think valuations are better. We have some questions that we'll address regarding the emerging markets. And we think if you can handle the volatility, there might be some value there. Okay, so no global recession. And the last one is a long-term theme. Firm, strong, and intellectual capital will drive returns the decade ahead. If you're a student of the markets and you've looked at the composition of how it's changed over the past 30 years, you've seen stocks like Exxon and Walmart and others go from being the very largest companies to large companies, but being well surpassed by Apple, almost 1.4 trillion, Microsoft, 1.25 trillion. We have Amazon and Google approaching $1 trillion, even relatively young Facebook at over 500 billion. So what's driving the market over the past few years and what we think is going to drive it ahead is intellectual capital. This could include technology, could include healthcare, a lot of things. Unfortunately, we think the U.S. is a leader in this on a global space. And once again, this dovetails with a lot of the individual holdings that our specific managers will be happy to speak with you about. So just I want to make a note on some of the geopolitical risks that we've seen. We've had a number of specific client conversations. We occasionally publish a brief thought piece on these items as well. And as you know, there's been some tension in Iraq and Iran. There was a U.S. embassy that was attacked, and we retaliated with a drone attack, killing an Iranian general. And the market fell about a few percent over the course of those 2 or 3 days. Tensions for the moment have seemed to cool down a little bit, but they can flare up at any time. Now, why I mention this is that our general philosophy is that political macro events are generally short-lived in nature, and in most circumstances, it's not going to cause us to change our portfolio allocation. We didn't change it last December 2018, when the trade tensions with China boiled over to a huge drop, 19% in peak to trough. And you might remember back in September, there were some attacks on the Saudi Arabian oil fields, potentially from Iran. We don't know for sure. And you can see how oil spiked and then it quickly came down. So fortunately, we're a much more diversified economy than we were decades ago. Some may remember the oil embargo from 1973 to 1974. Today, the U.S. is an energy exporter. We have a ton of oil, especially natural gas and mid-content of shale, and I think that reduces some political risk. So not that the risk is gone, but I think the risk of a spike in oil prices is much more serious 2 or 3 decades ago. Well, that's what I wanted to say in my prepared remarks. We do have some questions from the audience, and we're happy to field some additional ones. You may be able to, have you dial or email them in. I know we're having some problems with some audio.
It's on. Just
okay.
Maybe someone not dialed into the webinar.
Okay, so hopefully you're hearing us. As Brian said at the top of the call, we are recording this webinar, and in the event of technical difficulties, hopefully that we'll post that. And worst case, I'll just re-record it and post that for your information. So we do have some questions. I'm joined here by my colleague, Ermin Cervelek, who manages some of our funds as well as runs our open architecture portfolio. And one of the questions we have is on emerging markets. So Ermin, can you talk about how they've done and why they're in some of our portfolios?
Sure. Thanks, John. Emerging markets over the past few years haven't done as well as developed markets due to a number of reasons. One, because of the strong dollar, that's been a headwind. Also, the trade wars have impacted the emerging markets negatively. And lastly, there's been a cyclical downturn in the corporate earnings in emerging markets. So they haven't done as well as the developed markets and especially United States, because the United States has been really led by the tech companies, which represents a larger portion of the US-based indices. But looking ahead, we're pretty bullish on emerging markets due to a number of reasons. I mentioned the cyclical downturn in the corporate earnings, but looking ahead, we expect a secular uptrend in emerging markets due to better demographics. They have a much larger portion of their population that's represented by younger people that are going to be entering the workforce. Compare and contrast that to developed markets where there's a significant aging problem. I think that's going to benefit emerging markets over the long run. When you look at the current valuations, emerging markets trade at cheaper valuations compared to developed markets, and especially United States. The price to earnings multiple in emerging markets today is about 12, which is in line with its historical average. When you look at United States, that number is at 18 times earnings compared to the 16 multiple that the average is for United States. So it's cheaper than United States and in international markets, developed markets, and in line with its long-term historical average. The earnings growth rates over the long run in emerging markets is also a lot better than developed markets. The corporate earnings rate in EM is about 13% per year compared to 8% for developed markets. So better valuations, better growth prospects, and less debt. When you look at the EM government debt levels, that's at 47% of GDP compared to almost 100% in developed markets. A combination of demographics, valuations, and growth prospects, I think, makes emerging markets look pretty attractive today.
Okay, we have a somewhat similar question, Ermin, about why is there potentially need for small caps in a portfolio? We know they've lagged as well. I mentioned the S&P was up 35, small caps closer to 25 last year.
Sure, I'll address that as well. Over long term, small caps have outperformed large caps by a magnitude of 100 to 200 basis points. That's due to higher risk that comes with smaller capitalization companies. Small cap companies have higher leverage levels and lower credit quality than the large cap blue chip stocks. With that comes better returns. And when you look at the fundamentals today in small caps, one thing that's unique to small cap companies is that they only generate 15% of their sales in United States from sources in United States compared to 40 to 50% for the large cap US companies. So small cap stocks would benefit from any ongoing negotiation, discussion, and dispute about global trade. They do provide, small caps that is, they do provide correlation benefits in a diversified portfolio because they don't move in tandem with the large cap stocks that represent bulk of any investor's core equity portfolio. And also when you look at some of the things that have benefited small caps like tax cuts and deregulation, to the extent that those trends continue, I think small caps will outperform large caps, and they can add real value in a diversified portfolio. Not to mention the fact that they tend to be targets for M&A activity. So a lot of the smaller stocks can be takeover targets, which could also benefit their shareholder results.
Thanks, Herman. We also had a question on what should be the ideal average duration for a bond portfolio. So I'll take that. I chatted with my colleague, Susan Hayes, who runs our fixed income here at Beacon. And so first of all, duration is kind of also known as effective maturity. It takes the actual maturity into account as well as the coupons and discount rate. And right now the yield curve is upward sloping, but it kind of levels off. So once you go beyond the 5-year point, you're not really getting paid a lot extra to take on risk. So our view is that the ideal duration is somewhere around 4.5 years. It's a balance between getting a little bit extra higher yield than you get in a money market type account, but yet not taking on a lot of interest rate risk. Also in line with Susan's view, we still favor higher quality bonds at this time, both in the muni and corporate side, because we do realize it is getting late in the economic cycle. And even though high yield is at a great run, we don't think it's prudent to take on a lot of high yield risk at this time. So I don't know if we have any more questions. If not, I'll hand it back to Brian.
Nothing else has come in over the webinar. So just, again, we'd like to thank you for your time in dialing in and listening to our work. Certainly put a lot of effort into, developing an outlook. And as John said, we do expect, a relatively good environment to continue with the caveat that volatility will continue to pick up as we head through this year. Should be very interesting from a headline standpoint with everything that's going on both globally and here domestically, election-wise, and Brexit and the Middle East and so forth. So it should be an action-packed year, I think, from a headline standpoint. Our key job is to go make sure that we look through the headlines and dig into the data that's really coming in and make sure that we are proactive in making recommendations and potential changes, either to get, to do nothing in the case of the fourth quarter of 2018 that John had mentioned, or in the case of the current flare-up in Iraq and Iran, is to do nothing with the allocations or to make those slight changes.
We are long-term investors here at Beacon Trust. We'll maintain that long-term mentality. Our key focus will be to evaluate the short-term headlines and make adjustments only if there are long-term implications. Thanks again for your time this afternoon, and this concludes our webinar.